Hello everyone. In this session we are going to talk about illiquid assets. Agenda wise we'll first understand what are the characteristics of illiquid markets and what is the major relationship between the various imperfections that are there in the market. We know that the market has a lot of imperfections, and what is the relationship between the market imperfections and liquidity. Now we'll talk about different kinds of biases, especially for the returns that are reported for illiquid assets. Let's say I'm talking about property. The returns of the property are typically published. The return details of the property are published. Now this is an illiquid asset. There are so many biases that are typically coming up on the returns that are published. So we want to look at what are the different kinds of biases on the report on the returns that are reported, and what is the reported what is the of these biases. Then we generally talk about smoothing the returns to give a kind of a free flow in the trend and seasonality. So removing those kind of trends and seasonalities from the returns is what from the smoothened returns is typically called unsmoothing. We'll see why we need to do the unsmoothing of the returns, and then we will talk about for different kinds of asset categories, depending on the level of liquidity associated with them. How do I understand the illiquidity risk premium? So what is the level of risk premium associated with the illiquidity of that particular asset class? And finally, whenever I am trying to include any illiquid asset as a part of my portfolio, what is that I generally need to look at? So these are the various items that we are going to take up in this session. Now, the first thing all of us need to accept is any asset that we talk of in the world, it is illiquid to some extent. So some assets like, let's say, equity, bonds, we say that they are very, very less illiquid. Means they are more or less liquid, but again it's not that they are 100% liquid. So they are less illiquid, whereas on the other side, when I am going with property kind of assets, they are more illiquid. So it's only a kind of comparative term. What we are saying is almost all the assets to some extent they are illiquid. Because why is this illiquidity coming? One, frequency of trading. If any particular asset is very less frequently traded, obviously it is illiquid. And because the trading does not happen every second, we are talking of at least some amount of illiquidity in every asset category. Even the volume. See, if as long as I am able to sell or buy without impacting the price, then we are associating it to liquidity. But after a certain amount of quantity, obviously the price will have a movement, which indicates that at least some level of illiquidity is very much possible in every asset class, and even the turnover. So so the amount of turnover, if it is very, very low, that's an indication of illiquidity. Even if the quantity that is getting traded is also much smaller, that is also an indication of illiquidity in that particular asset category. So simply to summarize, almost all the assets, at least in some form, they are illiquid. So most of the asset classes are illiquid, and they are also large. Those illiquid asset markets. Right, if you look at OTC derivatives, which is a kind of an illiquid asset market, you see that it is very, very large compared to the liquid assets. Similarly, the property market, real estate market, or hedge fund market, you see that these markets are very, very large in size. So illiquid assets, size wise, they are very, very large markets. So investors, if you see in some form or the other, every investor holds a large composition of the illiquid assets. If I am owning a property, it's an illiquid asset. If I am owning some kind of high-end luxurious vehicles, they are illiquid assets. So you start thinking through different assets that you have. There is a good chance that every investor in some form or the other is holding lots of illiquid assets. Those assets which are very difficult to sell without compromising on the price. Right? Easy to sell at quick pace without compromising on the price. All those come under the illiquid assets. So every investor's portfolio in some form or the other is filled with a large proportion of illiquid assets. And in general, we see that for any kind of an asset, liquidity is going to dry up after a certain point in time. So these are some of the characteristics associated with the illiquid markets. Now, looking at the sources of illiquidity, right? One, clientele effects could be a very, very important source of illiquidity, because if you look at from the investor's perspective, they are not fully knowledgeable on various asset classes, the kind of risks, the kind of returns associated with them, right? And not even the participation costs are much, much higher. Trying to get, if I have to get information for various kinds of asset classes, so there is a huge amount of money need to be spent. The investor needs to invest his time, energy, get all the necessary skills before taking a decision of buy and sell. So overall, if you see, there is a lot of knowledge imperfection that is existing, which is again a major source of illiquidity. So if I have sufficient amount of capital, then I can do a research, and based on that I can think of what to buy, what to sell. Even expertise I have to develop over a quite a long period. Experience, again the same. Only in that case I can really evaluate the various investments and take my buying and selling decisions appropriately. So which means there is a definite source of illiquidity in this process. Similarly, transaction costs, there are so many. Why should I pay tax? Now if I am selling it, there could be a capital gain tax. So that could stop me from selling a particular asset. Right, the various other costs, commissions have to be paid, due diligence costs to do an initial feasibility study, etc. Title transfers are expensive, trading costs are involved, so there are so many transaction costs which are contributing to the illiquidity in the market, and various other intermediaries in the process, the fee that is paid to investment bankers, lawyers, accountants, all those contribute the various transaction costs which are becoming the major sources of illiquidity. Then finding appropriate buyer or seller. One, it takes time. Two, it may require an additional cost. So again, that's the source of illiquidity, because I may not be interested in selling it off, because search for a buyer or a seller is also an expensive thing which may not cover my selling costs. So there are so many search frictions. I may have to wait for a long time to do a transaction. Even that is what is called as illiquidity. So as I have already highlighted, asymmetric information. One investor has a higher knowledge about the product compared to the others. Obviously, the seller has more information compared to that of a buyer. So because of that, again the buyer has to take his own time to think, to come into the buying process. So whenever someone has to really do the buying, there's a lot of thought process that goes, there's a lot of evaluation that goes, and the intention is to look out for non-predatory counterparties to get into the trade. So which will be time consuming, money consuming, which is also another major source of illiquidity in the process. And obviously I cannot buy or sell large volume without impacting the price at all. So if the volumes of buying or selling are much larger, obviously the price has to be compromised. There's some kind of discounting thing, some kind of volume related compromise on the price. All these things typically come up, which again is contributing to the illiquidity in the process. And even the funding constraints, if I am already highly leveraged, I cannot get further loan or further borrowing to go ahead with the further purchase process. So my credit quality has already gone very bad. Those kind of illiquid asset markets cannot be transacted at all. So the more and more imperfections that are there in the market, in some cases all these imperfections cannot be immediately taken care of, cannot be immediately exploited to bring liquidity into the market. Right? If there are transaction costs, because of the transaction costs, any kind of market imperfection immediately cannot be converted into a buying or a selling decision, thus creating liquidity in the market. So it is always illiquid there. Even if there are such frictions, that would cause illiquidity in the market. So all these factors are really not exploiting the imperfections in the market, are not getting into the immediate trading process after observing the imperfections in the market, which is what is contributing to the increase of illiquidity in the overall markets. Then let's think of a slightly different dimension here. Now let's say we are reporting the returns for the illiquid assets. Take the property returns that are reported to form property index, or look at hedge fund returns that are reported by all the hedge fund managers to a central party to create a hedge fund index. Now there are so many biases that are coming into this whole process. One, survivorship. If there are some poorly performing funds, see, it's not mandatory that every fund has to report its returns for the computation of the index. So what can generally happen is those funds which are poorly performing, right, those funds which have suffered badly during a particular period, they will not do the reporting. So which means all those funds which have reported to this central agency, they are all well performed funds, highly performed funds. So obviously the average return is going to be much higher. The failed funds, failed returns, they are not captured as a part of the overall returns that have been captivated. So obviously the overall average return is going to be much higher because some of the poorly performing funds, they are not captured in the whole process. So the true illiquid asset returns are really worse than the reported. Reported looks the returns are much higher, but in reality their returns are much lesser because the poorly performing funds could not get captured into the overall computation. So what is suggested is, if at all this survivorship bias has to be removed, I have to look at computing all these returns based on the entire population data, not on the sample based, not on a convenience sample based on what has been reported by the various fund managers. So, but on the other side, if I have to go with the entire population, it's going to be a nightmare. Right? Even the reporting bias is very well possible. So that's something which we have to be aware of before we really think that these particular illiquid assets have a much higher return. Before we can conclude on that aspect, we have to keep in mind that these kind of bias is very much possible. Similarly, there could be a bias associated to infrequent sampling. The time period that has been considered for the reporting purpose may not be uniform across. Sometimes it could be a 9 months report, the return that could be reported. Sometimes it could be a 12 months return that could be reported, and then sometimes the return for 15 months could have been reported. So even the risk volatilities that have been reported, the frequency could be much different. Correlations that are reported, the time periods could be much different, and even the betas. So all these numbers could be completely different between across the different time periods, because the samples that have been used are completely different. Even that kind of a bias is very much possible. And selection, right? The results are observed when underlying asset values are much higher. See, if you simply look at this is the best example for you to understand selection bias. Right? If the property values are typically down, you don't find any seller selling any of the properties. So which means no transactions take place at all. So obviously I will not get the data for the reporting purpose at all. So they will wait until the market recovers, and only at that point they are ready to sell. So the data is available only at some specific points in time, especially when the asset values are much higher. So that is what we are calling as a selection bias. Right? From the real estate point of view, we can very well think that the sales don't happen when the property values are much fallen. So only when they have recovered and the asset values are much higher, only in that case you will find the property sellers typically selling. Until that time they don't mind postponing their sales. The same way, if you look at from the buyouts perspective also, the companies that are going for IPO, when the markets are completely down, they don't go for an IPO at all. Only when the markets are doing really good, you go for an IPO, which means the data for the IPOs is available only when the economy is as a whole is doing much better. So these are all the scenarios where we can see a selection bias, which could also impact the overall reported returns for illiquid assets. So as investors, we need to be very skeptical of the reported returns, because there is a good amount of possibility that these are all highly biased. Now, here the important concept we should keep in mind is the unsmoothing of the returns. So when we have done the smoothing, we have removed the noise, right? So we have removed the noise from the data and we have smoothened it out so that it shows a long-term trend and periodic seasonality in the data. But when we are doing unsmoothing, we are again bringing out the noisier returns from the smoothed data. So the noise that we have removed earlier during the smoothing process, the unsmoothing is adding the noise back so that the overall true returns can very well be understood. Right? So we are filtering the observed returns to estimate the true returns from the observed returns. So this is what we are using as a formula. We are getting our true return RT from the observed return. We are using some kind of a smoothing function. So the value that is the observed value at time t, observed value at time t minus 1. We are giving some kind of a weightage to both of them. And this is what, so the sum of the weights is typically equal to 1. And this is what is the process that we are using to unsmoothen out the returns from the observed smooth returns. So we are taking an autocorrelated series of observed returns, and based on that we are generating the true returns by working backwards by applying this kind of a filter. So this is what is the unsmoothing process. If you can really see some of the properties, the risk estimates are getting affected. The RTs are getting affected, not the return expectations. The returns don't change here. We are talking about only the risk estimates. The only reason being the whole in smoothing, the same shock that has come during a specific period, it is almost spread out across all the periods, because we have taken some kind of an average of the same. Whereas now from the average we are bringing out the original, So that is what is happening in unsmoothing. So the risk for that particular period is much higher. We are not spreading that shock over multiple periods. So that we have to understand. Return wise, we are just when see the overall return related estimates are not getting hampered because the average return will not change here. But the risk is going to change because earlier we have smoothened out that risk part because the returns are very smooth. So the risk part got smoothened out, but now because of unsmoothing, the volatility of the returns data is much higher, which is what is increasing the overall risk part, but not on the estimates of the returns. And if the observed returns are uncorrelated, right, RT and RT, they don't have any kind of a correlation, so it hardly matters, right? Even if I remove the even if I add noise to the data, it hardly has any kind of an impact. So unsmoothing really does not work because in smoothing out, we are trying to utilize that autocorrelation so that the overall average is going to go low. But when we are doing an unsmoothing, if the data is not correlated at all, we see that unsmoothing is of no use at all, right? But in reality, we see that the true illiquid asset returns, they are highly autocorrelated. So which means unsmoothing can really do a good job in terms of exposing individual returns more effectively. Now, how do I do unsmoothing? Is there a direct formula for doing it? Again, this is a formula, but again, we have a kind of weights and understanding what weight needs to be given. It's an art. So we can't directly say here it's only a first order. In this formula, I'm using a first order. Only one period lag has been considered. But in some cases, I may have to look at more than one period lag, 2 period, 3 period kind of lag. Non-linearity may have to be brought into the picture. So unsmoothing is an art. So I cannot just use this very simple formula to do the entire unsmoothing for all kinds of assets. So I have to really work out with a series of time series models to play around with all different kinds of time series models that fits the reported return data, and only then I would be able to do the unsmoothing more and more effectively, which means it's a very tedious process altogether. Now, coming to different asset categories, trying to understand based on the level of illiquidity associated with them, what are the illiquidity risk premiums that they are carrying. The major intention is based on the amount of risk that they carry, the investor need to be compensated with an appropriate levels of expected return. So the compensation to the investors for the inability to access capital immediately, that is what is contributing to the illiquidity. And even during the illiquidity crisis, I will not be able to sell my assets at all. So there will be a lot of difficulty in selling the asset at the price that I require, which means all these are different components of illiquidity risk. And if the investor is bearing all these illiquidity risks, obviously there should be some form of a compensation against this illiquidity risk. Now, what are the different ways in which I can capture the illiquidity risk premium? So there is a passive allocation I can do. Means regularly I am not buying and selling illiquid assets. I am doing a passive. Once bought, yes, it will be there in my portfolio for a good amount of time. So that is what we are doing in illiquid asset classes like real estate. We are setting a passive allocation. We are not doing an active buy sell in that particular space. So one thing that we will do for handling the illiquid assets is we will go with a passive strategy, or I am choosing securities within an asset class that are more illiquid. So if I am choosing those securities, even in equities, those that are more and more illiquid, if I am going with, there also I am trying to go for a illiquidity risk premium. And I can also act as a market maker at an individual security level to capture that illiquidity risk premium. I can get into a selling of an illiquid asset wherein I can charge something higher, and I can even engage in dynamic strategies to aggregate the portfolio level. So all these things, through all these mechanisms, I can capture the illiquidity risk premium. And some important points here: private equity investments generally are observed as more illiquid, but what we have seen is across the various asset classes, if I see, though majority of the private equity investments are illiquid, we see that some of them are more liquid than certain hedge funds. So if you look at the typical allocation, right, increasing illiquidity, if you are seeing the returns, these are the returns, and this is the level of illiquidity. So in general, it is the case that there is a kind of an increasing function. So as the illiquidity is typically growing, the return that is expected is also growing. But again, you could see the general scenario here. There are some kind of asset classes which are most illiquid, but this is how they are generating the average returns. Whereas there are some of them which are less illiquid compared to that of the timber and buyouts, etc., but they are generating more or less equal amount of a return. So it's not universally a highly correlated kind of a scenario that as the illiquidity is increasing, even the asset class returns is also, average asset class returns is also increasing accordingly. We could see that overall, yes, there is a positive upward sloping, but it's not necessary that for all the kinds of assets, for all securities within all the asset classes, the same trend is continuing. That's not the case. So if I look at the conventional view, there are a lot of illiquidity biases. That is what we have discussed, different kinds of biases in the process. So the whole conventional view, it ignores the risk, and there is no market index for illiquid asset classes. So that's where this representation that we have used, the traditional representation, there might be some kind of biases in this return that we have computed and presented. We have seen there could be a possibility of a selection bias, or there could be a infrequent related bias or a survivorship bias in the process. So the risk for each of the securities is completely different. So it's just not the illiquidity risk, in that there are many other risks that have to be taken into consideration when we are evaluating the overall return. There is a possibility of a credit risk, market risk, but these are not considered while that plot is being done, because we have just plotted it against the illiquidity. Whereas when I am talking of the return, apart from the illiquidity risk, many other risks also need to be considered. For illiquid asset classes, there is no market index, and if a couple of parties are typically generating a kind of an index return, there is a possibility of heavy amount of bias in the process. And factor risk cannot be separated from manager skill altogether. So that is where the conventional view of plotting the illiquidity versus asset returns has a lot of flaws in it. Now, a few important points within the asset class, if you see, this is between the asset classes, if I see, so these are some of the observations. But within the asset class, securities that are more and more illiquid, it is observed that they have higher returns on the average compared to those securities which are more liquid. This is within the asset class. Those securities which are highly illiquid, they have a much higher average return compared to those securities which are more liquid. And this can be accessed by various dynamic factor strategies, long positions in illiquid assets and short positions in the liquid ones. So that way I can very well access the illiquidity risk premium. I am taking long positions in the illiquid because they are more risky. I'm taking long positions, buying and holding, short positions in the liquid one. So that's the typical way I could say, because majority of the illiquid assets, they give higher return on average, and the liquid ones are giving lesser return on average. So if I have to exploit that kind of scenario, I'm taking long positions in the illiquid assets and I'm taking short positions in the most liquid ones. And if at all I want to include the illiquid assets as a part of my portfolio, few important points I have to think of. Now, there is no market index for illiquid asset. Even as a benchmark, whatever the index that I look at, it is not a tradable index. So illiquid markets don't have any tradable indices, which means if I have to really invest in illiquid assets, I need to have some kind of experts who can advise in the investments related to illiquid assets. So the portfolio managers whom I am selecting, they should have a lot of talent with respect to investments in illiquid assets. There is a huge possibility of agency issues in this process, and I have to really evaluate the performance of the portfolio managers, which can't be done so easily through some of our portfolio measurement exercises. Exclusive skills are required to evaluate the performance of the portfolio managers of illiquid assets, and to what extent I want to bear the illiquidity risk, and what is the kind of premium I require for bearing this illiquid risk is more and more of individual specific, because there is no active market for the same. It can't be driven by a rule like a CAPM out here. So more and more individual specific. Computing the illiquidity premium for each of the various asset classes requires different kinds of asset allocation models, combining different kinds of liquid assets and illiquid assets. Now, when I look at the important aspects of illiquidity, one, the transaction cost could be much higher. You think of property or hedge fund, the transaction costs are much higher, and the time between the trading, there is a lot of infrequency associated with the trading in case of all illiquid assets. So optimal holdings are quite drastically reduced. I may have to hold suboptimal kind of positions, because because of illiquidity, I may not be able to exploit the market differences for those or mispricings in the market. So which means the holding that I am having, the portfolio that I am holding, it may be completely suboptimal, and I have to rebalance the illiquid assets to positions which are much below the long run average holding. That is what we are calling as a suboptimal kind of holding. So what is advised is consume less with illiquid assets. There is no illiquidity arbitrage, so I cannot exploit that kind of an arbitrage at all, which means there should be a high demand for illiquidity hurdle rates. So when we are trying to include illiquid assets as a part of our portfolio, all these various aspects need to be taken into consideration, right? So these are the various topics that I wanted to discuss as a part of this session. I hope you got a good amount of understanding regarding these various aspects of this session. Any further queries you have, you can very well get back to me by giving me a call on the number that I have given below, or you can even send in an email at the email address that I have provided below. Thanks a lot for listening to this session. Thank you very much.